The transaction market has been on fire in 2026. Storage Mart kicking off January with news of $1 billion acquisition in New York City. And of course, Public Storage goes and 10X's that with their plans to buy National Storage affiliates. Joining me today, two of the people closest to the conversations of how that's affecting the rest of the transaction market in self-storage. Welcome to this week's edition of Storage Unlocked, brought to you by our good friends at PB Brown and General Contractors. I'm your host, Thaddeus Campbell. Pleased to be joined today by the co-founder and president of the Lindsey Self-Storage Group, John Lindsey, and senior vice president, although he doesn't look very senior, and managing director of self-storage investments at Matthews Real Estate, Austin McLeod. I wish we had been live like 10 minutes ago so you guys could have seen the interaction before we went live. Let's just say I'm smiling for a reason, really excited for what the next 45 minutes brings to us. Guys, I'm going to run through, as I told you beforehand, a few quick one-word answer questions for you guys just to get things warmed up. John, I'm going to start with you. Second half of 2026, same as the first half, hotter, colder in the transaction market?
Colder.
Austin, hottest segment right now, stable assets, heavy value add, lease up deals. Where are you seeing the things heating up?
Stable.
John, biggest driver of the sales we've seen this year. Why was the market so active early in 2026?
Maturing debt.
Austin, biggest holdup right now to more deals getting done.
Treasuries.
John, market you're most bullish on.
Red states.
Austin, market you're watching most closely, other than Tampa Bay, Florida.
Oversupplied. I was going to say oversupplied Southeast markets.
Got it. John, one thing investors should stop worrying about in self-storage.
Oh, street rates.
Got it. Austin, one thing investors should be more worried about.
I'd say incoming supply, but everybody's already worried about that.
Not enough, apparently, because it's still incoming.
Yeah.
We'll talk more about that later in the show because it's definitely, it blows my mind. Anyway, we'll talk more later. John, one word to describe the market as it sits June 11, 2026.
Exciting.
One word, Austin, to describe today's buyers.
Cautiously optimistic.
Love it. Enough of one-word answers. Let's dig a little deeper into some of the things that have really been top of the news. And we're coming up on 3 months since Public Storage made the announcement that they're going to acquire National Storage affiliates. That deal's supposed to close in the third quarter. John, your first reaction when you heard of that deal?
Not terribly surprised. I think it's a smart move for them. I think they were long overdue to make a big splash like that in the space. But I think what's most exciting about that is all of a sudden there's this massive institutional stamp on small mid markets that NSA operates in nationwide. This just further validates the space that we all play and trade in, day out. So I think there's going to be a massive push continued into these, acquisition and roll-up strategy throughout the Bible Belt and beyond where NSA is currently located. And all of a sudden, too, it opens up public to manage in all of these markets all of a sudden as well. So I think we're going to see a whole new swath of operators and investments going into markets they wouldn't have formerly looked at. And we're going to see even a further, more highly accelerated aggregation here in the space coming up here soon.
Austin, interested from your perspective, what jumped out to you as you saw the details of the planned acquisition?
Yeah, I mean, obviously public storage typically always wants to grow, and a lot of times that's through acquisitions. But I also know a big focus of theirs is more efficiency from an expense load standpoint and being able to share expenses across several different locations. And I think that, this acquisition obviously is very accretive in certain markets, but then it gives them scale in several others that they weren't already in. And now they can grow in those secondary and tertiary markets and again, spread expenses across several locations. So I think that, you're going to see their operating margin continue to grow and grow and grow as they do themselves with additional acquisitions. And I think NSA is, just going to help further that.
I couldn't agree with you more. I think they announced $110 to $130 million in yearly savings they expect to have by combining operational expenses, not only at the store level, of course, on a national level as well. John, I'm going to come back to you. What jumped out to me when I first heard it, right, is they offered 0.14 shares of public stock per share of NSA. NSA at the time was trading at $30. That the day they announced represented like almost $41 in value. Were you shocked at the premium that public was willing to pay based on what NSA was trading at the time?
I mean, no, not really. I mean, you look at where NSA was at its peak in COVID. I mean, it was up substantially where a lot of these owner operators got stocks and shares of NSA as well. So I'm not terribly shocked. I mean, look at the stamp they're getting, look at the footprint they're getting, and as Austin absolutely nailed, like they now have exposure in a lot of markets they formerly couldn't go to because of their expense load. So this totally opens up the floodgates. This is Public Storage buying the keys to the middle, smaller tier markets throughout the United States. So I think it was a really intelligent purchase on their end and a gap they've been trying to fill for a while.
I had a fascinating conversation a couple of weeks ago with Zach Dickens, of course, the chief investment officer at Extra Space. He's getting blazing, he's got to come up with something here to make something happen. But he made a fascinating point in saying that with the cap rates we're seeing transactions at, it doesn't vibe with the price that the storage REITs were trading at, right? The stock value implies that they're not worth anywhere near as much as cap rates we're seeing trade at. So I guess the question I want to come to you with, Austin, are we still going to see these cap rates trading at levels where it makes the acquisition of NSA look like an intelligent move? If you look at what storage transactions are happening right from a valuation standpoint versus what NSA was valued at from a stock price, Public Storage's acquisition looks a lot smarter, assuming, of course, that cap rates don't start rising over the next couple years. What are you seeing in the market today and in the 3 months since that transaction happened? Can we expect to still see things trading at these low cap rates?
Yeah, I mean, personally, I don't see cap rates getting that much higher. We did see about 150 to 200 basis points of inflation in cap rates from 2021 and 2022 compared to now. I don't necessarily see them getting too much higher unless the treasuries continue to rise. But on the same hand, I don't really see them getting that much lower for the next year or two. I think that will be kind of in the same type of cap rate range. And I will add as well, your Class A stabilized assets in primary markets are still trading at very aggressive cap rates, but there also aren't too many of those trading. You don't see too many fully stabilized, matured assets that are of high quality and highly desirable markets that are ultimately being sold. So when they come to market, they garner the most attention and most activity. The tertiary market deals, especially ones that are not stabilized, those have become of less and less interest to investors over the last 2 to 3 years. And those cap rates have certainly risen because of that.
John, I'd be remiss if I didn't let you chime in on this as well.
Yeah, so I think Austin brought a really good point. Those Class A products continue to trade very well. They're few and far between, and we're still seeing those Class A core market stuff trade at sub 5 caps for like really nice trophy 3-4 story Class A assets, and I think that will continue for years to come. The pricing for the Class B and C tertiary core plus product, it's already been priced into the cap rate. I don't think we're going to see a lot of volatility there. I think the buyer pool for that is getting more and more strict. And again, it's just harder to price in, especially for lease up deals in those markets. But again, what's interesting is we back out to this public acquisition all of a sudden. Now public could manage in a lot of these markets where they couldn't go before, and they might have one of the more efficient management platforms for stuff like that. So all of a sudden, you're not just like, am I limited to remote third party? Maybe I can actually have a REIT manage, which then opens up certain private equity groups that have to have a REIT third party. All of a sudden, they can go into markets they couldn't otherwise look at. So I'll be really interested to see how much that opens up the floodgates as we hit Q3, Q4 this year, and how that opens up into 27 as well.
Hadn't even thought of that, which is fascinating. I'm excited to talk about this and dig into a little bit of the gap between same store, similar market efficiency in Public Storage and NSA. You talked about their ability to manage. There is a vast difference in what they were getting for net operating income store to store when you compared portfolios when they announced the merger. Excited to dig into that. We'll talk more about this transaction and what it means in the market right after we take this quick break. Storage Unlocked is brought to you by PB Brown. Over $1 billion in ground-up construction delivered from single-story to Manhattan high-rise, institutional grade, engineered for performance, and designed to stand out. Great storage catches the consumer's eye, drives traffic, and helps lease-up happen faster. From Manhattan to Miami, California to Hawaii, PB Brown is the GC to trust for your multi-million-dollar storage development. Austin, I'm going to come back to you real quick. Obviously, both of you guys live a lot of the year in Tampa Bay, Florida. That's a market that has suffered from some pockets of oversaturation. A lot of the west coast of Florida, other places in the southeast as well. Are you surprised a little bit at the timing of the announcement of the transaction, given NSA is very prevalent in a lot of those Sunbelt states, and what we've seen for supply demands in those areas over the last couple of years?
I'm not necessarily surprised by the timing, no, nor was I by the announcement. Obviously, NSA does have some exposure in Southwest Florida, but they own in several different markets throughout Florida, as well as 20 to 30 different states across the country. So that risk certainly is spread out, and I think that it was probably good timing for both parties. I think that NSA was slowly working their way towards an exit, and public, as mentioned earlier, I feel like is always looking to grow. And so I think it was, good timing for both parties. And while Southwest Florida and some of those markets that they own in that's faced with a little bit of oversupply, may kind of be a little bit of a tough go at the start. Public, of course, has a very, very long-term outlook on all of their acquisitions. And I think that they're, thinking about these stores 30 years down the road and not for the next 12 months.
John, I'm going to transition here. Public Storage, of course, in their quarterly earnings report for Q1, and then again in the announcement of the merger, really talked heavily about how hard they're leaning into technology. They just announced a partnership with Welltower, which is the largest commercial real estate REIT in the world, aged community living, that they're working on technology platform together. Really interested to talk to both of you. John, I'm going to start with you. AI, of course, been all the rage in the last 12 months. It's can't do a podcast without talking about it. Doesn't work very well. I want to know from your level, as you're looking at opportunities and assets and underwriting things, doing broker opinions and marketing and listing assets. How are you seeing technology play a role on the buy side? What are buyers looking for? And are there things technology wise that are making a difference for sellers and actually getting them better prices on their assets?
Yeah, so I think I'll start at a high level and I'll come down on this because I think
Love it.
everyone thinks that AI is just going to take over the world and we're going to be run by robots soon and it's just the end of all civilization. But I think at the end of the day, people really forget how important it is to have a person on the other side of the phone when it comes to making these large investment level decisions. And so, although we're seeing these LLMs really being influenced with underwriting, data pulling, scraping rates, the access to information is so fast right now. And I think we saw the same thing when the internet first came out. Everyone thought it was going to be the end of every job and everything in the world. But all of these, OpenAI, Claude, all of them, they're hiring left, right, and center to have team members to oversee all their architecture, all their development. And right now, I'm sure you guys have heard of the AI vampires out in Silicon Valley. They're creating so many bots that are overseeing bots that are overseeing bots that they're able to process this large amount of data they've never thought they could in their lives before. So the tech advancement is just through the roof. And so we're seeing, some of these high-level coders making $50 million a year out in Silicon Valley, overseeing a total of 1,000 bots on a team. Their production is just through the roof. So I think it's amazing the pace at which we are about to advance in some areas. And again, the access to information, the internal development models, the underwriting, how can we get lean in certain expenses? I think people maybe lean in too hard too early and thinking that it's just going to absolutely change the game as far as acquisition and underwriting is concerned. But I think what it does is just increase the efficiencies at which we're able to sort through data, look at projects, understand markets, scrape relevant data in certain markets, construction projects, things like that. So I see it as a very big boost, but I think for storage right now and the way we're operating leaning, it might be a 2x. I don't think it's a 10x yet, just because there still is so much human involvement. And I don't really see that going away in our space anytime soon.
Austin, I'm gonna ask you, are you seeing facilities that are implementing, let's call it technology for now, because a lot of what I talk to for tech vendors, well, last week I shouldn't say that. I had your friend Kyle Lawrence's partner, Albert Kim, on the show, John Lindsey, and a couple of other guys, Ryan Chapman and Kyle Harper, who are not Kyle Harper. Why am I? Tyler Harper. There we go. Don't know why I forgot his name. Who are doing voice AI agents, which is about as AI as it gets. But a lot of the technology I think we've seen come into this space is much more workflow technology than it is actual AI. I'm interested to know, Austin, as you're looking at assets, have you seen this technology make a tangible difference in their NOI ultimately, right? Lowering expenses or increasing income in a way that is making those assets more desirable on the back end.
So honestly, at a store level, not so much at this point. Now, I would not be surprised if it's coming. And of course, I'm largely, just kind of speaking generally about the majority of deals that we're looking at. But at a store level, I haven't seen a significant shift in expense compression because of AI. Now, there are locations that are doing the, AI voice companion or having AI answer the phones. I've heard of some people that, are using somewhat of like a story ease virtual management model, but instead of an actual human being, it's, AI that comes over on the speaker. So there, are some unique things like that, but there are, of course, still expenses associated with that. And some operators are going to staff every single location regardless, and they're going to underwrite with 80 to 90 grand in payroll each year. So, if we're just looking at it at a store level, I haven't seen too much in, expense compression because of AI quite yet, but I have absolutely seen what John mentioned, which is just increasing the efficiency for each employee or acquisitions associate or analyst at these various firms. And I think that a lot of investors are getting smarter and, being able to analyze deals quicker, which certainly helps them and helps them grow their business. But at a store level, not so much.
And Thad, I'd love to piggyback on that. If
Go
I may.
to it, please.
So I think Austin brought up something really important that I'm sure Austin faces it just as much as I do. As much as I love AI, as do most people in the space, there have been times we've gotten responses back from buyers or sellers where clearly they put something into chat or Claude or OpenAI and they think it's right. And it's tough because Austin and I've been around long enough. We know what finished product looks like. We know what a correct output looks like for certain deals. And sometimes when stuff's just spit back to us, there's no validation piece. And I say, hey, I know you asked AI, but that answer is wrong. And I can explain to you why. So I would just caution everyone that your AI is as good as the prompts that you give it, and don't always blindly trust the outputs that it gives you, especially for underwriting deals. There needs to be a validation piece. And again, that's where I think there will always be a personnel level on top of the AI to oversee and make sure that the output is correct, because it is very capable of giving you the wrong answer. I think we saw that especially in the earlier versions of chat, and it's getting better, but it's a tool at the end of the day. It is not, completely overhauling your entire process and taking over it for you. So be cautionary of that. And I think we'll continue to see products that make it better and more efficient. But I would just say be wary and validate the information and data that's giving you at the end of the day.
I'm laughing over here as you tell this story. You guys know Kevin Bledsoe pretty well, and he called me. We had a conversation a few weeks ago, a buyer and a seller. Right. The buyer put it into chat and said, hey, chat's telling me I'm overpaying for this. And the seller put it in chat. Chat said, hey, it's telling me I'm not getting enough value for this. Right. So same project, same numbers. Hilarious. So to your point, trust but verify. Right. I'm interested. John, you and I were on a seminar with Noah Starr a couple weeks ago. Speaking of AI and mind blowing, I think both of us were sitting there with our jaw drop watching what Tract IQ is able to do when put together with Claude and ChatGPT. If you guys haven't seen that, reach out to the team at Tract IQ. They'll show you. But you mentioned something to me off camera there. You had done some research. The stunningly low number of people that have actually adopted AI in a way, especially paid platforms of AI. I was actually shocked by the numbers you were shooting out. I'm not going to lie. I did full doubting Thomas and had to go and do some research on my own to double check what you told me. You were not wrong even a little bit. Like less than 1% of the country has a paid membership on an AI platform. This is a super long intro for a question, but I'm interested to know, for you as the president of the Lindsey Self-Storage Group, how are you utilizing it in your brokerage firm, and what is it doing to help you guys on that front?
It's a great question. And I think I remember the data point, and I'll share it because I think it's fascinating. Only 8% of the world has a form of AI downloaded. 0.3% of the world have a paid version, and 0.1% are actually using it to its full capacity. So you think about it, and maybe because we're all in it, we're like, oh, I'm so behind on AI, but we have to remember we live in a vacuum here in the storage space. I feel like where we're all trying to figure out how to use it and understand it and stuff. So it will be amazing to see how that progresses. But all that being said, I think we have created a lot of more efficient systems internally, processes that can be automated with, logging CRM data and processing data as far as incoming rent rolls and spreadsheets and expenses into our internal models that we've built through Claude. So I think there's been a lot of efficiencies in digesting information that's giving to us and uploads that we can then work on it appropriately and be the malleable artists and understanding this product that we're going to sell at the end of the day. So again, it doesn't take away I think the artwork at the end of the day. It's just all that prep work and a lot of the back end stuff that formerly really just took time, especially when you're getting either facts, documents from a seller, or digesting rent rolls and seeing if there's missing pieces
Pen
or
and
gaps.
paper.
Yeah, it's just allowing us to process that so much more quickly and to pull gaps out of there. So and I'll even say, like, I've seen attorneys, CPAs, 1031 intermediaries, everyone that I interact with is using it. And it is amazing how great I think is going to continue to make our space as long as people trust but verify.
Austin McLeod, of course, Matthews Real Estate, started by Kyle Matthews, who's well known for not being on the forefront of anything and doesn't want to act out in front of the crowd at all. Talk to me a little bit about how Matthews is implementing AI and what it's done for you folks in your workflow.
Yeah, I mean, obviously at a company level, it's a little different than for me and my business specifically. For me and my team, a lot of it is kind of like what John was saying, where we use it to help us, collect and interpret a lot of data much quicker. I love using it for researching markets, more so on the residential development side, what's going on in this market, what's driving job growth, what's driving the income growth in this submarket, things like that. Most of the underwriting that we're doing is still manual. Sure, there's different things that you can do, like scraping rents and utilizing AI to kind of prepare a unit mix to input into our model. But for me and my analysts, we definitely try to be hands-on as it pertains to analyzing exactly which expenses need to be included. Were there any one-time expenses that we should remove? So there definitely is still that, kind of human touch that's needed. But yeah, at a company level, Kyle and his team are doing a lot of cool things. For us, we just built out our own proprietary CRM, and I know that we're utilizing certain AIs, different models to kind of aggregate a lot of the data that we have. So I'll let him talk more about that sometime. We should get him on one day, Thad. But yeah, at a company level, we're doing a lot of cool things that, I'm sure that we're excited to roll out.
Love it. And love the point. And honestly, something I love about all the people in the tech world that have come on the show over the last year, to a person, they're like, we're nowhere near not needing humans at every level of this. Even the AI voice agent people are like, hey, this is for the 80% of calls that are a pain in the butt for the human being answering them. It's not for that really high level important sales call that really needs a human touch on it. So fortunate, and I would say this to folks watching that might be worried about, AI's taking over the world. Nobody involved in building AI systems thinks of it as a replacement for humans. To both of you guys' points, a way to increase capacity and workflow for the people using it. I want to pivot a little bit, and I'm going to kind of lean on both of you a little bit differently here. John, obviously you grew up, for people who don't know, I think everyone in the storage industry knows at this point, but you grew up in this industry. Your dad, a developer and owner of self-storage facilities. We're in a really interesting time. Now, I got into it in 2021, so I've kind of only seen COVID boom and then the craziness afterwards. I didn't get to see the long run up to that. But I'd love for you to compare to me a little bit of where we're at in 2026. Mm-hmm. Are we still kind of living in what 23, 24, 25 were like? Is it more like some period you saw pre-COVID, or is it something unique to storage that we haven't seen in this industry before?
So I think twofold. One, rates are kind of back to pre-COVID. There's a normalization of like, hey, we've seen this boom and bust. We're back to normal level playing field. But I think from a time in history, very similar to post-GFC. We saw this huge slow in development. We're starting to see street rates come back up, occupancy come back up, and a massive amount of migration. 70% of the migration in the U.S. is going to North Carolina, South Carolina, Arizona, Texas, Florida. 5 states picking up 70% of the migration right now. So we're seeing this huge migration. We're seeing, again, coupled with slowdown development, increase in rates, rise, increase in occupancy. And all this back product that was overbuilt in 21, 22 is now being filled up. So I think we're going to see what happened in 10, 11, 12, and just this tick up in storage across the country. We're starting to really feel that momentum back in a lot of spaces. a market in North Carolina where we traded a lot was $18 at the peak of COVID, 11 after, and now it's back to 16. So like we've seen this ping pong, but I think again these markets are seeing their final tailwind, and Austin will echo this as well. A market just south of he and I in on the west coast of Florida still is getting hammered with product and rates. When you've got $1 billion of residential coming in, it's only time before it backfills eventually. So it's a matter of timing all these fill up, but overall, I'm very bullish on the current momentum of storage and where we should end up in the next 3 to 5 years.
Austin isn't old enough to run for president yet, so I don't know if I should even let him chime in on this, but hard to believe you're coming up on a decade in the self-storage industry. So you've kind of you saw that pre-COVID, big surge of investment start getting excited. We saw a lot of development start to happen pre-COVID. How would you sum up 2026 and where it stands relative to your time in the industry?
Yeah, I mean, I think back to 2018 and 2019, and the general consensus at that time was that the market was oversupplied. A lot of markets had been hit with a lot of new development from 2015 really through 2018. And a lot of that product struggled to get filled. And then you had COVID happen, and, we all know what transpired from there. So it is somewhat reminiscent of 2018 and 2019 for me, where there's a lot of product out there that's struggling to stabilize, or maybe they are getting full from a physical stabilization standpoint, but rental rates are 30 to 40, maybe even 50% below what they were projecting in their pro formas. It can be a tough time for some developers and owners right now, which we were definitely seeing back then. The difference is, of course, we were hit with a pandemic that caused an all-time high run-up in self-storage demand and rental rates. So, I don't know what's going to happen. I certainly hope that there is a catalyst that's going to spur outsized demand in the next 12 to 18 months and a lot of these locations fill up. But, obviously some markets will fare better than others, but it certainly does kind of remind me of that time period where rents are just kind of soft in a lot of these growth markets, and it's largely due to supply.
Preferably something that doesn't involve being forced to wear a mask.
Absolutely.
Don't even
resist.
Don't even that.
Knock on wood. John Lindsey, I want to ask you, because he opened the door for a conversation I was actually going to get to later, but this, could not talk about it, which is the incredible oversupply that we've seen in the last, really going back to 2017, when we saw the most self-storage built ever that year in terms of number of developments. That number has continued to go up, so that even in 24, 25, when I thought there would have been a massive drop off in new developments, the number of new developments that came online in those 2 years beat 2017, was the record to that time. How are we seeing new developments still be this strong in the self-storage space?
I think it's twofold. One, from a consumer standpoint, there's obviously been an uptick of interest and consumption that I don't think will slow down anytime soon here in the States. A lot of markets that I think people had thought were oversupplied based on a national rule of thumb metric. Now that we have access to better data, rates, occupancy levels, technologies, we're realizing that there's small gaps in a lot of these 3-mile pockets. And so we're seeing people continue to build in some of these markets. I mean, even look in South Tampa, where Austin and I are, like, rates continue to climb. People are clamoring to continue to build there. I mean, when you're seeing the migration and investment that's going to some of these markets, it's hard not to want to be a part of that long term. I think where we will see people shy away, there's a number of markets where people overbuilt. It's clear we built it for 18, it's worth 13. I mean, just absolutely getting shelled on some product. And I don't think they necessarily were wrong in their thesis. It's purely a timing standpoint. And unfortunately, a lot of people got 5-year money in 21 or 22. I looked it up again this morning that we were tracking over 1,000 CMBS loans are coming due in the next 12 months. It's going to be tough for a lot of operators, and it's unfortunate. I think it's just kind of where we are in the market. And the difference is this time versus post-GFC, there are so many firms, funds, and capital buckets lined up to pick up assets like that didn't exist the first time. There was no safety net the first time. And so there are groups that have been waiting for this opportunity and waiting for this moment. And again, it's an unfortunate where we are in the cycle, and rarely do we see storage assets not work. And again, I don't think they're not going to be successful over a period of 7 to 10 years, but unfortunately in 5 years, they just didn't get to where they needed to be based on this, Swiss cliff of rates and occupancy. And as Austin nailed, physically they might be there, But if you perform at $18-$20 rates and you're at $9, it's hard to make that work at the end of the day.
Yeah, hard to refi when you're at a 0.8, right, DSCR, right?
Yeah.
And begs another question to you, Austin. I've kind of been sitting here for the last few years waiting for some bloodbath sales to happen, and by and large haven't seen that on any type of a scale at all. I've been a little surprised at that. To John's point, with 1,000 CMBS loans coming, are we going to start to see transactions where, quite frankly, the equity piece of the puzzle loses out, where people are selling where their investors don't get their money back? Debt gets paid off, but investors not so much.
Yeah, I mean, we already are. There already have been sales that have been completed at a loss, and maybe not all of the equity gets wiped out, but a good portion of it. And I think that we will continue to see that, and it is unfortunate. I've only seen a handful of foreclosures, so not nearly as many as some people were projecting when the Fed started their rate hiking cycle. But we've definitely seen some GPs bite the bullet and ultimately decide to go and dispose of assets, even if it is at a loss. And everybody has their own reasoning. Some want to move on to the next project. Some have debt coming due, but we already are seeing it. I certainly think it could accelerate if we don't see demand pick back up in a meaningful way. And like I said a few minutes ago, I think that there needs to be some catalyst to kind of spur new demand and just cause an uptick in overall consumer demand for storage. And if we don't get that, then I think that some more people will ultimately capitulate and meet the market. And some of those sales may be at losses or, ultimately at their basis. But I do think that it has to happen, especially as debt rolls.
Love it. John Lindsey, I want to ask you the question. The fact that we haven't seen a bigger bloodbath yet, more to do with the financing piece of it being extending and helping out owners in the short term, or just the strength of self-storage in general and the number of people that want to buy assets, allowing people to kind of get out without getting too burnt?
I think both, just very dependent on some of these assets. I mean, we have a number of large developers, they build 3 dozen, 50, 100 assets. They, one or two are built in certain markets. Their lenders are very willing to work with them to kick that can down the road and give them the time. As Austin alluded to, we've already had a couple sales where they're basically walking at their debt cost, maybe a little more to cover closing expenses. And it's an unfortunate reality, but I can only name maybe 3 or 4 deals that have actually gone to a foreclosure process. And I think because people believe in the asset class so strongly and know that eventually a lot of these markets will continue to build out, it just might be a 7 to 10 year horizon, not a 3 to 5. I just don't see a massive foreclosure wave. There might be a lot of deals that people are saying, oh my gosh, I can't believe they were able to buy this at that price tag. But there's always a buyer. I just don't see a lot of stuff going all the way back to the bank without someone stepping in to either scoop the debt or pick it up before it gets to that point.
Austin, I want to come back to you. Shout out to Hans Hardesty, by the way. Hans was supposed to be the third person on this roundtable. He's at Mid-Atlantic SSA, and I screwed up, and I gave him the wrong time, so he couldn't join us. But I was with Hans up in Connecticut a couple weeks ago at the Northeast Storage Expo, and he mentioned a deal that he sold in Syracuse, New York. Secondary market, not a growth area at all, right? If you've ever lived in Syracuse, which I have, 2 inches of snow every single day all winter. Nobody's clamoring to move there if they don't have to. 35-year-old property, professional management, right? So no real mark-to-market upside on the deal, and it sold at less than a 6 cap. Mind-boggling to me. Austin, how is that still happening in a you mentioned the treasuries earlier. I think the 10-year right now is around a little over 4.5.
Four and a half,
to have a spread. Figure if you're getting long-term debt traditionally, you're not below 5.5 by any stretch. How's someone buying these deals at less than a 6 cap?
Well, I think it all depends on the buyer profile, because if it's an extra space, public storage, one of the top private equity funds, they have a cheaper cost of capital than you and I and most higher net worth individuals even. So their debt costs are much cheaper, probably low to mid 5s right now. And they can afford something, in the high 5 cap range with the expectation to grow it to a 6 to a 6.5 in 3 to 4 years from now. The reason why we're seeing a lot of Class B, Class C assets in secondary and tertiary markets trading in the high 6s to low 7s is because of exactly what you described, Thad. Most individual investors that go out and either use their own capital or syndicate the equity from friends and family, they're going and they're getting bank debt, or maybe it's life co debt, but that's going to be, priced at 200 to 250 basis points over the 5-year, the 10-year treasury. And that's where you get interest rates in the mid to high sixes. And those guys have to buy deals in the mid to high six cap range, if not at sevens, in order for those deals to pencil. It's the Class A product, or, you described, an older asset, but certainly a large enough asset with population density to where it likely was, somewhat of an institutional buyer with a little bit of a cheaper cost of capital. Because if not, it's very challenging to make deals pencil, in the low six cap range, unless there's a very strong value add story in a very short period of time to be able to increase rents, et cetera. So I think, for me, it all comes back to the buyer profile a lot of times and why we're able to sell these deals. It's like John said, Class A product can trade in the high fours, maybe even low fives to mid fives, depending on the asset and the market that it's located in.
John, this begs two questions for me. I'm going to ask the first one to you. Is the fact that the cost of capital for these big equity groups, Merritt Hill, City Line, Prime, you name them, incredible access to being able to raise hundreds of millions of dollars at a very low expected return from their investors. And then, of course, we know what's happened. I think $1.6 billion in either JV or bond sales from the REITs in the last 12 months, which is mind-boggling, the amount of money they've raised to be able to deploy. Is this saying something about the strength of the industry?
Absolutely. I mean, and it goes back to even just
that was a dumb
storage
question, honestly. It's,
no, I mean,
it's obviously saying something.
No, but
it's not my best
dumb,
question
though.
ever.
No, Thad, I think it throws the biggest institutional stamp on our space ever. Like, as if we thought we couldn't get any hotter. Public Buying NSA says, hey, Wall Street now believes in core middle markets. That's huge. Like that to me is everything. Like, we have the largest storage operator in the world now wants to be in the Jackson, Mississippi's of the world, which is just awesome. Like, there's gonna be a whole new wave of capital deployment, interest. I mean, I'm sure Austin, we can name dozens of funds that are out raising hundreds of millions of dollars, if not billions of dollars right now, ready to deploy in this space. And we're getting bigger and bigger names, whether it's sovereign wealth funds, private equity, endowments, like you name it. Everyone's in storage. It's not going anywhere. I think there's a very aggressive consolidation wave coming up. We're going to continue to see it for years. So I'm very enthused. I will say I was obviously expecting rate cuts by this time in the year, if you asked me in January. And that's when you asked me, how do I feel about the second half? And I said, slow. It's not slow. It's just slower than I expected it to be. I mean, it's, no one was like, oh yeah, maybe a rate hike next week, but it's on the table. It's a wild, year we're in right now.
That begs another question, which I'm going to come back to in a second, but I'm going to ask the second question that Austin begged me to ask when he talked about the Syracuse deal, which is this for me. And I just asked this question on a poll in LinkedIn. And quite frankly, I was shocked by the answers that I got. I asked, is there a path for someone newly in storage to actually build any type of scale in a portfolio, given the capital abilities of the big PE groups and the REITs right now? Are we done with someone new coming into storage unless they change the paradigm of what they're doing? I mentioned Tyler Harper earlier, from Homegrown Storage, and using technology in a way that is just so far afield, different than other people. Absent some new paradigm of how you manage these facilities, is there a pathway for someone to come and compete with that big capital?
Is this one for me, Thad?
Yeah, I apologize. I said that way back about 10 minutes ago before I asked the longest question ever.
No. So I would say yes. It all just depends on what you're trying to buy and where you're trying to buy. But I mean, we have seen some private investors that have grown a pretty impressive portfolio. SW Group comes to mind for me. I've done a couple deals with them. They're buying another one from us in Ohio. I've been raising friends and family money. They've got about 13 assets right now. And, they're going to continue to grow. They started out buying assets that are not going to be targeted by a Public Storage and by an Extra Space. And, they've been able to win a deal here and there, and they just take a little bit of a different approach. So the opportunity absolutely does still exist, in my opinion. It just depends on what you're buying. It's going to be hard to go in and win a marketing process on a $25 million Class A asset in downtown Atlanta. But if you're going to buy deals on the outskirts and you're going to be creative and you're going to be willing to take on some value add projects, you can certainly amass a portfolio if you have the capital to do it.
John, want to chime in on that one?
Yeah, no, absolutely. I think what's really cool now, I think through this consolidation wave, the cost of capital has made it very competitive in this space. But all of a sudden, we've seen the rise in this tech stack from its 10 Fed management, Copper, SAM, white label stories. Like everyone's starting to get more efficient with their virtual platforms and using AI tools like Storage Pilot and things like that. So again, I felt like we were kind of hitting a wall, and now we've backed off a little bit due to the tech stack that's available out there. As Austin mentioned, though, tough to compete on Class A, multi-story, and core markets. But we saw this kind of backpedal from the core plus tertiary product. I think now, if you have the right cap stack, it's a great time to try and attack those with the tech that's available in the market. So I'll be really interested to see what that looks like, especially after the public NSA merger moving forward.
Guys, I'm going to wrap up here. Cannot thank you enough. Top right to me, I don't know what you guys are seeing on your screen, but Austin McLeod, he's the Senior Vice President and Managing Director, I think is the official title, of self-storage investments at Matthews Real Estate. John C. Lindsey, Founder, President of Lindsey Self-Storage Group. If you're an owner of a self-storage asset, I hope that if you've watched this for the last 40 plus minutes, you realize how intelligent, how insightful these two gentlemen are, and that your assets would be in amazing hands with either one of them. You can reach either of them through their LinkedIn platform. I think my guy Eric, probably in the background, has a couple of emails he can pop up here for both of them. If you don't know how to get a hold of these two guys, which is not that hard to find, reach out to me and I'll connect you to them for sure, and make sure that you touch base with them. If you need it, even a broker opinion of value could not be in greater hands. Austin, John, I want to thank you so much for being so giving with your time, but also for the incredible insight and the answers that you gave during the show.
Of course, man. Thanks for having us. And Austin, I'll see you in Tampa.
Yeah, absolutely. Thad, thank you for the opportunity. Great to join you, and look forward to the next one.
Absolutely, my pleasure. Before we sign off, I want to give one more shout out to my friends at PB Brown General Contractors for sponsoring the show. Check them out at pbbrown.com. If you have a ground up development, reach out to them early. They can help you really understand what your project is going to look like and what the cost will be associated with that. That's it for this week's edition of Storage Unlocked. Tune in next week for another great episode of the show. Thanks all for watching.